Assalamu alaikum, dear students. Hope you are well. I am Sosa. I am Mohammad Samad Khan, lecturer, Department of Accounting, Dhaka College, Dhaka. I think all of you are well and all of you stay at home and stay safe. Okay, dear students, today I will discuss about Modigliani and Miller's theory. Modigliani and Miller's theory, it is first introduced at 1958 by Franco Modigliani and Merton H. Miller. Modern capital structure theory began at 1958. On that time, Professor Franco Modigliani and Merton H. Miller, Howard Miller, published the article which is the most influential finance article which is ever written. The article published in American Economic Review. Modigliani and Miller showed that this theory holds more generally under the set of confidence and conditions referred to as assumptions of perfect capital market. Dear students, any theory depends on some assumptions like NOI approach theory or NI approach or traditional approach. So every approaches have some assumptions. So theory also has some assumptions which are written in this board. So we see what are the assumptions of Modigliani and Miller theory. Okay. So first one is the securities are exchanged in the perfect market. It is called fully competitive market, capital market. So this especially means that first one is the securities are divided into many single small groups. I mean single small groups. Shares, small shares. It is a small lot of shares. Okay, dear students, then investors are free to buy or sell securities. Here investors are independent to buy or sell securities. Okay. Then third one is investors got the equal opportunity for debt as the firm. Here said that the firm which is equal rights as the investors. If firm getting the chance of for getting the debt. So investors already also getting the chance to get the debt as the firm. Okay. Then no transaction cost to exchange securities. Whenever exchange want to exchange security, then there is no transaction cost. Okay. Investors get the information for free of share securities. The total information of the share securities investors get the securities for full free information, total informations. They behave rationally and logically. Investors are behaved rationally and logically. 2. With total information and rational behavior, every investor expects that the value of the firm can be determined by net operating income, which is called EBIT, earning before income and tax. Okay. Then 3. Firms can be grouped into homogeneous risk classes. I mean, firms, all of the firms are categorized about their risk level. Okay. Then 4. Firms distribute all of the operating earnings, all of the earnings to the shareholders, which means 100% payout ratio. I mean, at this moment there is no retained earnings, or there is no reserve earnings. I mean, all of the earnings are distributed among the shareholders. Okay. Then 5 number, last one is no corporate income taxes exist. Here there is no corporate tax. So Modigliani and Miller's theory are presented into two categories. I mean, it is with taxes or without taxes. So we should say that here Modigliani and Miller's model is presented. Modigliani Miller's theory is presented into 3 propositions. Proposition 1, proposition 2 and proposition 3. Here proposition 1 and proposition 2 are relevant to this theory, but proposition theory is not relevant, I mean irrelevant to this theory. So, dear students, let's discuss proposition 1. In the proposition 1, dear student, I think all of you already write down in your script. Proposition 1. Proposition 1. The overall cost of capital and the value of the firm are independent in proposition 1. So, the impact of leverage, there is no impact of leverage in the proposition 1. So, in the proposition 1, VL equal VU. Okay? Here, VL equal, it is called value of levered firm, and then VU equal value of unlevered firm. Okay, so in proposition 1, BL equal VU. So we should bring out the value of the firm from proposition 1. So value of unlevered equal EBIT or NOI divided KO, overall cost of capital, or it will be brought by another way. It is called EBIT or NOI divided KEU, cost of equity unlevered. So here KU, overall cost of capital, and then KEU, cost of equity unlevered firm. Okay, so dear students, okay, in this proposition BL equal BU, so value of unlevered firm equal value of levered firm. So by this proposition we should, if we learn this proposition, we should solve a problem about this proposition, I mean about the proposition number 1. So let's solve a problem. Dear students, say company A, company B, okay, say here common share. Common share is, it is 60% share, it is 100% share. Okay, then 10% debt. 10% debt is 2 lakh, and there is no debt in company B. Okay, EBIT or NOI is 75,000 taka. Here is 75,000 taka. Okay, and then cost of equity, there is no cost of equity. Here is 12.5% cost of equity, company B. So we see this in this problem, it is levered firm and it is unlevered firm. Okay, so it is unlevered firm. We know that value of levered firm equal value of unlevered firm. Okay, so value of unlevered firm equal EBIT, we already learned this, EBIT or NOI divided KEU, because here there is no overall cost of capital. So here 75,000 taka, then overall cost of capital is 12.50%. Okay, so it is 6 lakh. Value of unlevered firm, I mean total value of the firm of unlevered firm, I mean company B, is 6 lakh. So value of levered firm, for proposition 1, value of levered firm equal 6 lakh taka. So from the proposition number 1, we get the value of the firm of the company A and company B is 6 lakh taka. So dear students, I expect that all of you already understand what I want to say. Okay, dear students, let's see what is said in the proposition number 2. Proposition number 2. Okay, dear students, model, Modigliani and Miller model suggest to bring out the overall cost of capital, I mean KO, of levered and unlevered firm in second proposition by the sense of proposition, second proposition, if we add financial risk premium, if we add financial risk premium with unlevered cost of equity, then we will able to find out or find out the cost of equity of levered firm. Okay, so here it is called in proportion to that if we add financial risk premium with unlevered of cost of equity, then we'll able to find out the cost of equity of levered firm. So cost of equity, what are the clue? Cost of equity levered firm equal cost of equity unlevered plus risk premium. Okay, so it may bring out in another way cost of equity levered, it may bring out in another way, that is cost of equity unlevered plus cost of equity unlevered minus cost of debt into D divided S. So please, from proposition 1, just we learn this. From proposition 1 we get value of the firm. From proposition 1 we get the value of the firm. Value of the firm is 6 lakh taka. Then value of debt is 2 lakh taka. It is 4 lakh taka. I mean market value of the shares. Market value of the shares. It is market value of the shares 4 lakh taka. I mean S equal 4 lakh. So we know that so cost of levered firm equal cost of equity unlevered plus cost of equity unlevered minus cost of debt into D divided S. So here cost of equity is unlevered is 12.50% plus 12.50% minus 10%, which is alluded in the question. 10% for levered firm. Here debt is 2 lakh. Then S, I mean 4 lakh. So here is 12.50% plus 2.50% into 2 divided 4. I mean 12.50% plus 1.25%. I mean 13.75%. Okay, if we compare, it is cost of equity levered firm. It is cost of equity levered firm. So here, if we compare between cost of equity levered and cost of equity unlevered, then we can see that there is a little difference. I mean, cost of equity unlevered equal 12.50%, and then cost of equity of levered firm is 13.75%. I mean, there is a little difference. I mean, 1.25% difference. Okay, so dear students, it is said that if we get a debt by a small interest charges, then we will balance or will make a optimum capital structure. Okay, dear students, last one, we should prove that what is the overall cost of capital. I mean, in this value of unlevered firm, there is cost of equity unlevered equal 12.50%. I mean, to 12.5%. Then, so overall cost of capital will be 12.5%. So because for unlevered firm, cost of equity unlevered equal cost of overall cost of capital unlevered. Okay, so we should bring out the overall cost of capital by in the proposition 2. Dear students, overall cost of capital, at first we should write down which is the overall cost of capital 2. So cost of overall capital equal S divided V into cost of capital levered plus D divided B into KD. Okay, so here already we see this, that the market value of the shares is 4 lakh, then value of the firm is 6 lakh, cost of equity levered is 13.75%. You already bring out this, then plus D, I mean 2 lakh, then value 6 lakh, and KD is 10%. Okay, dear students, we calculate this. $9.1667, say, then 2 divided 6 into 10, I mean 3.3333. So 3.3333 plus 9.1667, so 12.50%. Okay, dear students, I think you already learned that what is the workings of MM models, and how we bring out the overall cost of capital from proposition 2, and how we bring out the value of the firm from the proposition 1. Dear students, we will solve the proposition 3 of Modigliani and Miller's theory, and we should solve the maths with taxes. I mean Modigliani and Miller's theory with taxes. It is without taxes, and we will be doing next class with taxes, Modigliani and Miller's theory with taxes. So, dear students, I expect that all of you will do this math at your home and stay safe. Thank you.